Have you ever wondered how the current economic climate is impacting the commercial real estate market? With the Federal Reserve keeping interest rates steady, the multifamily sector booming, and industrial vacancies on the rise, there's a lot to unpack. Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. In May 2025, the commercial real estate market is navigating through a mixed economic landscape. While the U.S. economy hit a speed bump with a slight slip in GDP due to anticipated tariffs, the job market remains solid. This mixed picture is reflected in the commercial real estate sectors, where some are showing signs of gradual improvement, while others are grappling with high vacancy rates. Starting with multifamily properties, this sector is showing remarkable resilience. Annual net absorption has increased by 22% to over 544,000 units. Even though construction has decreased by 30% from the previous year, new supply still outpaces demand by 16%. The vacancy rate remains steady at 8.0%, and rent growth is modest at 1.1%. Notably, Class B units are leading the market in absorption, while Class A properties, despite having the highest vacancy rates, have seen a slight improvement. These trends are mirrored in both Canadian and U.S. markets, with major metros like Dallas, New York, and Atlanta each absorbing over 20,000 units, highlighting solid demand even in high-cost areas. Turning our attention to office properties, the sector is facing challenges. Demand weakened again in April after a brief improvement in March, resulting in net absorption turning negative and vacancy rates rising to 14%. Rent growth remains flat at around 1% as tenants exercise caution. Class A offices have managed to maintain positive annual absorption, but saw vacancies rise to 20.3%. In contrast, Class B offices are performing relatively better with slower vacancy growth and stronger rent gains at 1.3%. Regionally, while Boston and Los Angeles posted significant losses, New York saw a sharp rebound, swinging from negative to positive absorption over the past year. The industrial sector, known for its strong demand over the past few years, is currently recalibrating. Although demand remains robust, it cannot keep pace with the influx of new supply, leading to higher vacancy rates. Rent growth has slowed to 2.1%, yet it still surpasses that of other sectors. Logistics continues to thrive, but flex space is lagging. Savannah, Georgia, topped all markets in absorption, while Los Angeles led in vacancies, reflecting a similar trend seen in parts of Ontario, Canada, where industrial spaces are also recalibrating due to rapid supply increases. In a recent article by Elise Franco from the Charlotte Business Journal, it was reported that a new office development is set to bring soaring lease rates, marking the biggest jump we've ever seen. The development, located in Uptown Charlotte, is expected to significantly impact the office leasing market. As new office spaces become available, the surge in lease rates is anticipated due to the high demand and limited supply. This scenario echoes the broader trends we're observing across North American markets, particularly in cities like New York and Los Angeles, where similar dynamics are playing out. It's a fascinating development that underscores the shifting landscape in commercial real estate as urban centers continue to evolve. In Richmond, Virginia, a historic building on Broad Street is undergoing a transformation after years of vacancy. The three-story structure at 2033 West Broad Street, once a vibrant hub for the LGBTQ community as the Fieldens Club, is set to be converted into 9 apartments along with commercial space. This redevelopment is spearheaded by local developer, broker, and investor Burke Turnbull, who purchased the property last September for $800,000. Turnbull has embarked on a historic tax credit rehabilitation of the century-old building, which totals around 14,000 square feet, including a finished basement. Burke Turnbull, known for his involvement with the Vale Brewing Company's local tap rooms, plans to include 1,500 square feet of ground-floor retail space in the redevelopment. When asked about the type of tenant he envisions for the commercial space, Turnbull humorously remarked, "Anyone but a vape shop." The architecture firm Ratio is responsible for the project's design, while Smithcraft Construction serves as the general contractor. Construction is currently underway, with an anticipated completion date by the end of the year. The building, located in the West Broad Street Industrial and Commercial Historic District, has a rich history. Originally highlighted by a showroom for the Atlantic Motor Company, the building's past use in the early 1900s remains somewhat unclear. However, it gained significant cultural importance from 1977 onwards, when Gary Fielden Edwards opened Fielden's, a late-night club that quickly became a beloved venue within Richmond's LGBTQ scene. It was a place where the community gathered for a variety of events, including the eccentric Hamoen fundraiser and performances by the Richmond Triangle Players, a local LGBTQ theater company founded in 1993 by Steve Earle. Philip Crosby, the executive director of the Richmond Triangle Players, reminisces about Fielden's as a legendary space. The theater company performed there for over 15 years, making use of the top floor where drag queens also showcased their talents. Crosby notes that despite challenges such as cigarette smoke and the building's deteriorating condition, Fielden served as a safe haven for the LGBTQ community during its time of operation. Following the closure of Fielden's, the property was acquired by the owners of the Paper Moon strip clubs, who rebranded it as The Mansion. However, the venue eventually closed, leaving the building vacant until its recent acquisition by Turnbull. Reflecting on the building's storied past and its role in the growth of the Richmond Triangle Players, Crosby expressed satisfaction that the site is being revitalized into residential apartments. He commented on the significance of the building and expressed optimism about its new chapter, marking yet another evolution in the diverse narrative of 2033 West Broad Street. In Kyiv and western Ukraine, the demand for commercial real estate is on the rise, even amidst the ongoing conflict. Yaroslav Burik, a member of the Association of Real Estate Specialists of Ukraine, has noted that investment in commercial real estate is seeing the highest rates in the relatively safer western regions of the country. Despite the full-scale conflict, the capital city of Kyiv is also experiencing strong demand. While the pace of the market has slowed, the industry is showing signs of gradual recovery. According to Burik, the rental of retail space has already returned to pre-war levels. The rental cost varies depending on demand and location, ranging from $10 to $50 per square meter. The State Statistics Service has reported that in the first quarter of 2025, the total area of non-residential buildings put into operation in Ukraine reached 617,916 square meters. Industrial and warehouse buildings make up the largest share, with 271,302 square meters. Other non-residential buildings account for 180,460 square meters, while wholesale and retail buildings constitute 111,008 square meters. Office buildings represent 26,467 square meters, and hotel and similar buildings cover 8,549 square meters. This data reflects the ongoing demand across various commercial real estate sectors in Ukraine, even as the country continues to face significant challenges. In a recent piece by Brian Paskus, published on May 29, 2025, in the Commercial Observer, a fascinating trend is highlighted in the world of commercial real estate investment. Despite a landscape filled with uncertainties, some investors are choosing to lean into the chaos rather than retreat. A notable example is Scott Reckler, CEO of RXR, who signed a letter of intent to purchase 590 Madison Avenue in Midtown Manhattan for $1.1 billion. This move marks the first office sale in New York City to exceed the $1 billion threshold in nearly 3 years. Reckler's approach, as described in the article, is rooted in a contrarian mindset. He sees the current economic dislocation as an opportunity, noting that when many institutions view office spaces as uninvestable, it's precisely the time to invest due to reduced competition. This contrarian strategy echoes the successful paths of past investors who capitalized on similar market conditions, such as David Walentis and Bill Zeckendorf Jr. The article also discusses how other investors, like Chad Carpenter of Revan Capital, are capitalizing on distressed office properties, while Sean Hehere of Trinity Investments has successfully navigated hotel investments. Carpenter, for instance, has launched a $1 billion real estate investment trust to acquire distressed office assets, highlighting the potential for substantial returns when buying at significant discounts. This contrarian approach is not without risk. The article points out the challenges posed by the current economic climate, including high treasury yields and federal budget deficits. These factors contribute to a volatile market that demands careful navigation. Despite these challenges, investors like Reckler and Carpenter see the potential for high returns by targeting undervalued assets and leveraging their knowledge of market cycles. The article concludes by noting that while the market is fraught with uncertainty, it also presents unique opportunities for those willing to take calculated risks. As the commercial real estate landscape continues to evolve, contrarian investors may find themselves well-positioned to capitalize on these shifting dynamics. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.